Now, we all want to retire at some point, but what's the best way of funding your retirement? Buying a property or building a pension pot of investments? In this video, we're going to go 5 rounds on which is best and then deliver our knockout view right at the end, so stick around for that. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat low interest rates with simple tutorials and strategies that get you investing in the stock market and earning a better return. Please like the video and subscribe to the channel and turn on notifications, and also send us an email if you have any questions. We'd love to help. So, which is better to fund your retirement, a property or a pension pot? Property is certainly familiar to us Brits. We love our castles, and with property prices having surged so far for so many decades, many of us are sitting on small fortunes. I say us, not me, I'm a millennial, so I can't afford a house. Anyhow, when it comes to retiring, in order to turn this investment into an income stream, you could downsize and sell your property, or you could move to a cheaper property and invest in a buy-to-let. Now, pension pots, on the other hand, invest in the stock market, and they come with plenty of juicy tax breaks to bribe you to lock that money away until retirement hits, which is when you can finally get your hands on that hard-earned pile. Now, property is seen as a solid investment and familiar. It's as safe as houses, whereas pensions are all that strange, intangible investing thing. But both have pros and cons. So the question is, which will leave the bowling club grandees green with envy and fawning at your feet? So today, we're going to haul both of the options into the ring and go 5 rounds to decide which is best, and then we'll give you our opinion right at the end. And please don't forget to subscribe to the channel. All right, round 1. How do each fare for income and growth of your money? Well, both a stock market-based pension and buy-to-let properties have the potential for the same winning combination of long-term capital growth and rising income provisions. Rising values have, of course, come from either the rising property market or from surging investment assets such as company shares, and both have the potential to deliver inflation-busting rising income, either as rents and buy-to-lets or dividends from company shares. Now, a big advantage of property is that you can borrow to make investments, and it's fairly easy to do so because mortgage regulation in this country is pretty light touch, and this enables you to tap into bigger investments than would be ordinarily possible with a smaller sum. But of course, both also face the possibility of losses, and any leveraged investments, such as with a mortgage, will enhance your losses even further. Traditionally, the property market has been less volatile than the stock market, meaning prices bounce around less vigorously, but house prices can still fall. Just think of the early 90s or around 2008. One other thing, with property, you tend to be less diversified, as your investment is in one or just a few assets versus the many investment assets that you will likely have within a pension portfolio. Still, after round 1, it's pretty neck and neck. Okay, round 2, which has the best tax advantages? Now, when it comes to tax, property is left on the ropes. Pensions win hands down as you get showered with free money. So for every £1 that goes into a pension, the government adds another 25p if you're a basic rate taxpayer, and additional ratepayers will attract additional sums. If you're eligible for a pension at work and you haven't opted out, then your employer will also top this up by at least 3% of qualifying earnings. Then the pot can grow free from any income tax, capital gains tax, dividend or interest taxes. And once you start drawing from it, you can take 25% tax-free too, and then utilize tax-free allowances to cut the tax you pay on anything outside of this tax-free amount. Finally, when the time comes to pass on to the next life, your nearest and dearest won't pay any inheritance tax either, as your pension pot is not part of your taxable estate. Buy-to-let properties, on the other hand, can present some hefty tax bills. If it isn't your main residence, there's 3% extra in stamp duty land tax. Income from rent may face income tax, and the government has whittled away any tax breaks on buy-to-let mortgage interest payments too. Sell it and it will be 18% or 28% capital gains tax above the 12,300. After death, it is part of your taxable estate, which means up to a 40% haircut. I think pensions win this round. So round 3, the hassle of one versus the other. Now I think you can probably guess that property is the standout pain in the proverbial. It's pricey. You got to scrape together thousands of pounds for deposits and then go through surveys and solicitors and searches and stamp duties before you can even get your hands on one. You also need to do some serious homework to find a property with plenty of room in your rent to cover all those chunky running costs, including mortgage, maintenance, insurance, managing agents if you're using one, emergency repairs, and periods where it may go empty. Now, pensions, on the other hand, come with much lower costs, often under 1% in platform and investment fees, and they are much more predictable. Maintenance is limited to just adjusting the mix of investments from time to time, which is what, of course, Steps to Investing is here to help you with. Or, of course, you could pay a financial advisor another 1% to do everything for you. Ultimately, pensions are not going to phone you in the middle of the night to say the tap has been ripped out of the wall and that you might need a canoe to get in and out of your property. I think pensions win round 3. All right, round 4, accessibility before retirement. Now, the big advantage of property, aside from being able to borrow money to bat for bigger returns, is that you can crystallize your gains at any point and use the cash if you really need it. With a pension, you're going to have to wait around until you're 55 at the moment before you can access it, and that's going to rise to 57 in 2028. And then beyond that, who knows, we'll probably all be working till 80 till we're allowed to access our pensions. I think property is fighting back in this round. All right, round 5, taking income in your retirement. So we're on to our final round. And here you would think rent from buy to let would be pretty good for a monthly salary. However, you're going to need some spare cash to cope with any gaps between tenants and also to cover any unexpected bills. It's also difficult to get hold of money tied up in a house. Selling property can take months, and even remortgaging involves fees and lots of paperwork. With pensions, you face more choices with how to take an income. Of course, for those who aren't lucky enough to have a defined benefit or final salary pension which pays out a set amount. Now, you're going to need to weigh up whether you use some or all of it to buy a guaranteed income known as an annuity, or leave it invested and sell down bits and pieces when you need it, known as drawdown. Overall, annuity rates are a bit rubbish at the moment as they're linked to interest rates, whereas dipping into a pension is fairly easy to do, although if you get it wrong, your money could run out before you do. In the final round, pensions edge ahead. They may require more decisions, but are far more flexible, and you can always pay an advisor to help. All right, so how do we conclude this? Well, property is familiar, it's an asset we understand. It can kick out monthly income, which keeps up with inflation, and you can borrow through a mortgage to punch way above your weight. But if you want an easy life, pensions offer far more flexibility later on at lower costs and without the unexpected bills and hassle. Plus, you can snap up free money in tax breaks and employer contributions to boost your retirement savings. If you'd like to learn more, go to stepstoinvesting.com. Until next time, goodbye.